There's this really weird, incredibly frustrating phase of building wealth that almost nobody warns you about. You've been grinding for years, maybe you started with zero, or maybe you were in debt, and you finally did it. You checked your brokerage account, your 401k, your savings, and the combined total has crossed that magical, psychological six-figure threshold. You have $100,000. And honestly, for about 10 minutes, you feel like an absolute genius. You feel like you've cracked the code. But then, almost immediately, that feeling fades, and it's replaced by this quiet, nagging anxiety. You start looking at that $100,000 and realizing that if the market drops 20%, which it does every few years, $20,000 just vanishes into thin air. That's a year of savings for some people, gone in a week. You start realizing that $100,000 sounds like a massive amount of money until you run the retirement calculators and realize it's barely a fraction of what you actually need to retire comfortably. And so, out of pure fear, or maybe just habit, you double down on the exact same investing strategy you used when you had $1,000 to your name. My name is Zach, and I spend way too much time thinking about money, financial psychology, and why some people seem to effortlessly build wealth while others stay stuck in the same financial patterns for decades. And I started noticing something really fascinating among the people I talk to, the readers, the viewers, the people who write in. The ones who get stuck hovering around that $100,000 to $300,000 mark for literally a decade are almost always doing the exact same thing. They're treating a six-figure portfolio like a micro-account. They haven't updated their mental software. What I want to share with you today is the exact pivot you need to make in your head and in your brokerage account once you cross that $100,000 threshold, because the strategies that get you to six figures are not the strategies that are going to get you to $1 million. And if you don't make this shift, you're going to spend the next 10 years just spinning your wheels, wondering why the math isn't working out the way it used to. To understand why you have to change your approach, we have to talk about the math of momentum. When you are starting from zero, or $5,000, or even $10,000, your primary wealth-building tool is your income. You are the engine. The money you put in every single month is the only reason that account is going up. If you invest $1,000 a month, and the market goes up 10% in a year, your $12,000 in contributions is doing way more heavy lifting than the $1,000 or so you made in compound interest. It feels amazing because you have total control over it. You work hard, you see the balance go up, you feel validated. But something happens right around $100,000. The math starts to flip. If you have $100,000 invested and the market goes up 10%, that's $10,000. If you're still only contributing $1,000 a month, which is $12,000 a year, the market is almost matching your entire year's worth of labor in a single 12-month span. By the time you hit $200,000, the market's normal fluctuations are completely dwarfing your monthly contributions. And this is where people panic. Because suddenly, you don't feel like the captain of the ship anymore. You feel like a passenger. You look at your screen in January and see your portfolio drop $15,000 in a week, and you think, wait, I didn't sell anything, I didn't do anything wrong, how did I just lose a used car? That feeling of losing control is what drives people to make incredibly stupid decisions right after they hit their first major milestone. They start doing things like trying to time the market, moving to cash, or chasing high-flying meme stocks just to feel like they have a hand on the wheel again. You have to stop investing like a laborer who is trying to manually build a brick wall, and you have to start investing like an architect who is managing a construction site. You are no longer the sole source of momentum. Your job has shifted from creating the wealth to protecting and directing the wealth. Once you accept that the market is now doing a lot of the heavy lifting, you can breathe a little easier, but you also have to realize that your mistakes are now magnified. A 1% fee on a $10,000 portfolio is $100. Who cares? But a 1% fee on a $200,000 portfolio is $2,000 a year. That's a vacation. That's a month of groceries. The scale has changed, and your strategy has to change with it. The very first thing you need to stop doing once you cross $100,000 is blindly buying fractional shares of anything and everything without looking at the tax consequences. When you have a small account, tax loss harvesting is kind of a joke. Oh great, I sold a losing stock to save $30 on my taxes this year. Wonderful. But when you have a $100,000 plus portfolio, taxes become one of the largest silent wealth killers you will ever face. Let me give you a real-world scenario that happens all the time. You bought a total stock market index fund 3 years ago. It's done well. You have $30,000 in unrealized gains. Suddenly, you get a bonus at work, you have $10,000 sitting in your checking account, and you decide you want to be clever. You sell that $30,000 position and immediately buy a different S&P 500 fund because you read somewhere that it has a slightly lower expense ratio. You think you're being a smart, sophisticated investor. Do you know what you just did? You just triggered a taxable event. Depending on your income bracket and how long you held it, you might just owe the IRS $4,500 in long-term capital gains tax. You literally took money out of your pocket, handed it to the government, for absolutely no reason, just to switch from Fund A to Fund B, which are essentially the exact same thing. When you have a small portfolio, you can afford to be sloppy with asset location and tax efficiency. When you cross $100,000, you cannot. You need to start understanding the difference between your taxable brokerage account, your Roth IRA, and your traditional 401k. Your high-growth, high-dividend, or actively traded assets need to be sheltered inside your tax-advantaged accounts. Your broad, low-turnover index funds should live in your taxable brokerage. And please, stop swapping funds around in your taxable account just because you heard a new podcast recommending a slightly different flavor of the exact same index. At this level, it's not about what you make, it's about what you keep. And the IRS is standing right there, waiting for you to slip up so they can take a massive cut of your momentum. The second major trap that catches people at the $100,000 mark is what I call the set it and forget it delusion. Now, don't get me wrong. For 95% of people, buying a boring 3-fund portfolio and never looking at it again is the absolute best advice in the world. But there is a dangerous subset of people who take this too literally once their account size gets serious. They set up auto-contributions, they pick their funds, and then they literally do not log in for 3 years. They don't rebalance. They don't check if their target date fund has mysteriously shifted their asset allocation. They just let it ride. I actually knew a guy who did this. He finally hit $150,000 around age 35, and he was so proud of his hands-off approach. Fast forward to a bear market, and he logs in for the first time in 2 years and realizes that because of a job change and a 401k rollover, 80% of his entire net worth was sitting in a single tech stock that his old employer had matched. He had no idea. He thought he was diversified because he used to be diversified. When your portfolio is small, a lack of rebalancing means your allocations drift by a few percentage points. Who cares? But when you have $200,000, a booming stock market can easily push your stock allocation from 80% up to 95% without you realizing it. You are now taking on massively more risk than you originally signed up for, entirely by accident. You need to stop investing like a passive bystander and start acting like a portfolio manager. Even if that just means logging in twice a year, once in June and once in December, just to look at the pie chart. If your stocks have grown too large, sell a little bit of the winners, tax efficiently of course, and buy bonds to bring it back to your target. It feels counterintuitive to sell the things that are doing well to buy the things that are lagging, but that is literally the entire mechanism of buying low and selling high. At the $100,000 level, you don't need to day trade, but you absolutely must steward your money. You are the guardian of that 6-figure nest egg. Act like it. Now, let's talk about something that almost nobody wants to admit, but it is the single biggest reason people's portfolios stall out after they hit their first major milestone. You have to stop investing only in paper assets. When you have $5,000, putting 100% of it into the stock market makes total sense. You need the growth, you need the compounding, and you don't have enough capital to diversify into real estate or businesses anyway. But there comes a point, usually right around that $100,000 to $150,000 mark, where the stock market becomes a little bit like a roller coaster that you are locked into. You can't control when it drops, you can't control when it goes up, and if you need the money at the wrong time, you are completely at the mercy of the market gods. I remember reading about this concept a few years ago, and it completely changed how I viewed my own money. The idea is that your first $100,000 should be almost entirely focused on liquid, growth-oriented assets, index funds, ETFs, because your number one goal is scaling the mountain. You need the oxygen, you need the momentum. But once you reach that first base camp, your strategy has to broaden. You need to start allocating capital toward things that give you leverage and control. What does that mean? It means maybe you don't put your next $50,000 into the S&P 500. Maybe you save up a $20,000 down payment for a duplex. Maybe you start a small side business that requires $5,000 in startup capital but has no ceiling on returns. Maybe you invest in your own skills by paying for a certification that doubles your income at your day job. The stock market gives you an average 8% to 10% return, and that is incredible. It's a miracle of modern finance. But a $10,000 investment in a business that generates $20,000 a year in side income completely blows that 10% out of the water. I'm not saying abandon the stock market. I'm saying that once you have $100,000, you finally have enough capital to start playing different games. If you just keep dumping every spare dollar into a brokerage account, you are leaving massive opportunities for parallel wealth building on the table. You're trying to win a soccer game by only using your left foot. At some point, you have to use the whole field. This brings me to the fourth shift, and honestly, this is the one that messes with people's heads the most. You have to stop obsessing over your rate of return. When you have $10,000, a 20% return in a year is $2,000. It's awesome, it feels amazing, it makes you want to brag to your friends. But when you have $200,000, a 10% return is $20,000. And a 20% return is $40,000. But here's the dirty secret of large portfolios. Chasing a 20% return when you already have a lot of money is the fastest way to lose it all. When you have $100,000 plus, your absolute biggest enemy isn't underperformance. It's drawdown. Let me explain what I mean by that. If you have $100,000 and you lose 50% of it in a risky crypto play or some leveraged ETF that you didn't understand, you now have $50,000. To get back to $100,000, you don't need a 50% gain. You need a 100% gain. You have to double your money just to break even. The math of losses is brutal. I see people who have beautifully grown their accounts to $150,000, and suddenly they get bored. They start buying options. They start putting 10% of their portfolio into some random biotech stock they saw on Twitter because they want the portfolio to move faster. They are treating a $150,000 portfolio like a $5,000 casino chip. You have to transition your psychology from growth at all costs to wealth preservation and steady compounding. Do you know what a 7% to 8% year-over-year return on a $300,000 portfolio looks like? It's $21,000 to $24,000 a year in pure, passive, do absolutely nothing money. That's a part-time job's worth of income just showing up in your account because you had the patience to let a boring index fund do its job. Stop looking for exciting investments. Exciting investments are how wealthy people go broke. You want your money to be like watching paint dry. You want it to be incredibly boring, incredibly predictable, and incredibly relentless. Let's take a quick step back and talk about something that kind of annoys me, and maybe you feel the same way. It's the narrative that is constantly pushed in the personal finance space that you should just automate everything and never think about money again. It's this utopian idea that if you just set up your auto investments, you can go live your best life and magically become a millionaire in the background. And look, for the accumulation phase from $0 to $100,000, that advice is pretty solid. But once you cross that threshold, life gets more complicated. You might get married. You might buy a house. You might have kids. You might decide you want to retire at 50 instead of 65. These are massive, life-altering decisions that require you to actually sit down and look at your money. You can't just set it and forget it through a divorce, or a career change, or an inheritance. When you hit $100,000, your financial life transitions from being a simple math problem to being a holistic life planning exercise. You have to stop investing in a vacuum. What I mean by that is you can no longer just ask, what is the best performing index fund? You have to start asking, How does this money serve the life I am trying to build? If you realize you absolutely hate your corporate job and you want to start your own business in 3 years, having $150,000 sitting in a locked-up 401k doesn't help you. You need to be intentionally building a taxable brokerage account, building cash reserves, shifting your asset allocation so that you have liquidity and options. Money is only valuable to the extent that it gives you options and freedom. If your investing strategy is perfectly optimized for a 65-year-old retirement, but it leaves you feeling trapped and miserable at age 35, it's a bad strategy. You have to start aligning your portfolio with your actual human life, not just some generic retirement calculator you found online. The next thing you absolutely have to stop doing is letting your cash drag destroy your returns. This is such a silent killer for people in the $100,000 to $300,000 range. You sell a house, or you get a bonus, or you build up an emergency fund, and suddenly you have $40,000 sitting in a checking account at a major brick-and-mortar bank earning 0.01% interest. You tell yourself, I'm going to invest it, I'm just waiting for the right time, I'm waiting for a pullback. Or worse, you just get lazy and forget about it. Meanwhile, inflation is eating 3% or 4% of that money's purchasing power every single year. You are actively going backwards. When you only had $5,000, having $2,000 in cash wasn't a big deal. But when your net worth is $150,000 and $40,000 of it is sitting in a standard checking account, you have a massive problem. You need to ruthlessly optimize your cash. Move it to a high-yield savings account immediately. Even better, if you know you won't need it for a year, put it in a high-yield CD or a treasury bill. At the $100,000 level, you should literally be earning thousands of dollars a year just in interest on your cash reserves. If you aren't, you are leaving free money on the table. Stop letting banks use your money to make loans while they pay you absolutely nothing in return. It takes 20 minutes to move your cash to a high-yield account. There is no excuse not to do it today. Now we need to talk about fees. I know, it's the most boring topic in personal finance. But bear with me, because when you hit $100,000, the math on fees becomes genuinely infuriating. Let's say you have $150,000 invested, and you're paying a 1% advisory fee to some robo-advisor or a financial professional who does nothing but put you in expensive mutual funds with 0.75% expense ratios. Between the advisory fee and the underlying fund fees, you are losing around 1.5% to 1.75% of your entire portfolio value every single year. On $150,000, that's over $2,500 a year. That is a phenomenal vacation. That is a massive down payment on a car. That is a year's worth of groceries for a family. And what are you getting for that $2,500? A phone call once a year where they tell you to stay the course. When your portfolio was $10,000, a 1% fee was $100 a year. It was the cost of a nice dinner. You didn't notice it. But now, fees are a material drain on your wealth. You need to audit every single penny you are paying to invest. If you are using index funds and ETFs, there is no reason you should be paying more than 0.1% or 0.2% in expense ratios. And unless you have an incredibly complex tax situation or an estate worth millions of dollars, you probably don't need to be paying a 1% assets under management fee to a human advisor. You can manage a $100,000, $200,000, or $500,000 portfolio entirely on your own with a simple spreadsheet and a few low-cost funds. At this stage of the game, you are the CEO of your own wealth. A good CEO doesn't tolerate vendors who overcharge them for mediocre services. Fire the expensive funds. Fire the unnecessary advisors. Keep every single basis point of return that rightfully belongs to you. Over a 20-year period, the difference between a 0.1% fee and a 1.5% fee on a $100,000 starting balance is hundreds of thousands of dollars. It is literally the difference between retiring early and working an extra 5 years. Take it seriously. Let's touch on something that rarely gets discussed in the polite, sterile world of personal finance YouTube, and that is the emotional toll of crossing $100,000. Up until this point, your investing journey has likely been a purely optimistic one. You're putting money in, The general trend of the market has been up for the last decade, and you feel like you're playing a video game where you just keep leveling up. But once you cross six figures, you experience your first real bear market as a wealthy person. And I use the term wealthy loosely, but to you, $100,000 feels wealthy. And when a correction hits and your $120,000 drops to $96,000 in a matter of weeks, it breaks something in your brain. You stop seeing numbers on a screen and you start seeing things. You think, that's a Honda Civic that just disappeared. That's a kitchen renovation that I can no longer afford. You have to stop investing like someone who is psychologically unprepared for volatility. How do you do that? You build emotional armor before the storm hits. You do this by running fire drills in your head. Right now, while the market is relatively calm, look at your $150,000 portfolio and imagine it is $105,000 tomorrow. Ask yourself, does this change my life? Do I need to sell? Am I going to panic? If the answer is yes, your asset allocation is wrong. You have too much in stocks for your actual risk tolerance. It is infinitely better to have a portfolio that grows at 6% a year that you can sleep through a 30% crash with, than to have a portfolio that grows at 10% a year but causes you to panic sell at the bottom of a bear market. I've seen people who meticulously built their way to $200,000, watched it drop to $140,000, got scared, moved to cash, and then the market recovered over the next 2 years and they were left sitting at $140,000 with no way to get back in because they were traumatized. Don't let that be you. De-risk your portfolio slightly if you need to. Hold more bonds or cash than the internet calculators tell you to. Protect your peace of mind, because at the $100,000 level, your psychology is your most valuable asset. Finally, the last thing you must stop doing after your first $100,000 is tying your self-worth to your net worth. When you go from $0 to $100,000, your net worth is a reflection of your discipline. You sacrificed, you saved, you worked hard, and the number is a direct reflection of your good behavior. But after $100,000, the market takes over. As we discussed, a bad year in the market can wipe out $30,000 or $40,000 of your net worth, and you didn't do anything wrong. If you tie your identity to that number, a market crash will feel like a personal failure. You will feel stupid. You will feel like you made a mistake, even if you did everything perfectly. I've talked to people who hit $200,000, then the 2020 pandemic crash happened, and they dropped to $140,000. Even though they didn't sell, even though they kept contributing, they felt this deep, lingering shame. Like they were somehow a fraud for having lost so much money. You have to decouple your identity from your brokerage account balance. You are not your portfolio. You are a person who happens to own some financial assets. The money is a tool. It's a store of your future time and freedom. It is not a scorecard of your value as a human being. When you can finally make that psychological separation, investing gets so much easier. You stop checking your phone nervously. You stop caring what the financial news is screaming about on any given Tuesday. You just go to work, live your life, contribute your monthly amount, and let the machine run. Hitting that first $100,000 is a massive deal. If you are there, or you are close, you deserve an incredible amount of credit. Most people never get there. They spend everything they make, they fall into debt, they give up. The fact that you have built a six-figure portfolio means you have already proven that you have the discipline, the patience, and the foresight to win this game. But the game changes now. You are playing in the big leagues. The mistakes are more expensive, the taxes are more complex, and the emotional swings are much wilder. You can't keep using a beginner's playbook in an advanced game. You have to shift from being the person who is manually pushing the boulder up the hill to the person who has built a system where gravity and momentum are now doing most of the work for you. Stop making sloppy tax mistakes. Stop ignoring your asset allocation. Stop leaving your cash to rot in a zero-interest checking account. Stop chasing unrealistic returns that threaten to wipe out years of hard work. And above all else, stop thinking that what got you here is automatically going to get you to the next level. Take a deep breath. Look at that balance. Be proud of it for a moment. But then, log in, look at your fees, Look at your tax efficiency, look at your diversification beyond the stock market, and make the upgrades. You have built an incredible foundation. Now it's time to build the rest of the house. You've got this. Just make sure your strategy reflects the level of wealth you've actually worked so hard to achieve.